Hello, good day. If you are new to this channel, welcome, and don't forget to hit the big subscribe button below and click the bell so that you won't miss anything. We are going to tackle for today adjusting entry. So what is adjusting entry? Adjusting entry are journal entries to recognize income and expenses that occur and are not accurately displayed in your record. You create adjusting entry at the end of the accounting period to balance your debit and credit, or rather, it would be better to say to put your accounts correctly, because accrual state that accounts should be recorded when earned rather than when received, or when used rather than when paid. So, if from the word itself, you would see that there are two kinds. Number one is the deferral or the deferred payment, or some would call that as prepayments. So, advance payment in short. And then the other one is deferral, which means that these are deferred payment, meaning you didn't pay, but you already incurred the expenses. So, let's take a look for a better. So, number one, from our example before, we have Kurt. We have on January 11, Lay paid 3 months rental to Kurt. So, we have rental which we paid on January 11. But take note, after January 11, was it still good? Or you could say that there is already a payment received given by Lay, but the incurrence of the service from the lessor has not yet been incurred, because it would what? It would pass from, so on January 11 to February 11, that would be 1 month. And then February 11 to March 11, that would be second month. And then the third month would be from March 11 to April 11. So if you would see, our transaction on that is until August. So all the rent are already consumed. So we would now do our adjusting entry, which is debit rent expense 30,000, and then credit prepaid rent 30,000. Okay? Okay. Next is that, remember, we incur consulting services that was engaged to render consulting. Take note, to render, meaning it's not yet being rendered, or Lay didn't do the services that are needed by the LCUP. So that's why we entry cash 50,000 and then unearned 50,000. But what if we would do some assumption? Suppose Lay already rendered the services by the end of August. So if it's already rendered, then therefore Lay don't have any more liability. Instead, the money is already for her because she already rendered the services. So we would now do the adjusting entry, which is state that unearned revenue debit 50,000 and then credit revenue 50,000. So if you would go back to our T account, we would now have a beginning balance of unearned revenue 50,000, and then the adjusting of 50,000, it would what? It will now be 0. Okay? Next is that we also have the so-called Lay bought supplies at 5,000 cash. So take note that the supply is usually consumables like pens, paper. We usually consume it. So we would have a certain assumption that suppose by the end of the year or the end of our accounting period, we notice that the supplies only cost 2,000 that was left. So we would now entry debit supplies expense 3,000 and credit supplies 3,000. So if you would go back to our T account, you will have now what? Remember our T account before? We have supplies, beginning balance of 5,000, and then we already use up the 3,000. So we would have a balance of only 2,000. So which is correct? Because we say that the goods already left is only worth 2,000. Okay? Next, we also have the depreciation. So take note, suppose that they bought a computer 25,000 on account. So, computer, 25,000 and then accounts payable, 25,000. But take note, your computer's value at the end of the year would not still be 25,000 because we already used it up. So, depreciation is a recognition of expenses on a year-to-year basis because you use the property and its value go a little bit lesser as you utilize the equipment. Okay? So, we just use straight line. So, straight line, the formula would be cost, which is the 25,000. Then we go to our assumption, said that additional assumption, computer has a life of 3 years and salvage value, sorry for wrong spelling, value of 4,000. So, what is the salvage value? Salvage value is the amount that at the end of its useful life and you sell that particular equipment, you will be able to get a certain amount of 4,000. So we have now cost 25,000 and then salvage value 4,000 divided the life of the asset, which is 3 years. So we have 7,000. But take note that we only use this equipment for 11 months. So that's why we multiply 11 months and then divide it by 12 months. So we only have 6,416.67 depreciation. So entry would be accumulated depreciation expense, 6,416 in accumulated depreciation. But take note, if you would see, the computer is not being credited. So because accumulated depreciation is a contra asset account that is deducted to its main account, which is the computer. Okay. Next. And lastly, an example of our accrued expense. Suppose we realize that Christopher's salary was not paid in August. So take note, we don't put an entry. But salary is always due to our client to our employee at the end of the month. So we would record now his salary of, sorry, I guess this one is 20,000. Okay, accrued salary 3,000. $20,000 because his salary previously is 20,000. Okay, so we would not have a liability and additional expenses with this accrued expense. Okay, 20,000 or salaries, accrued salaries, or it could also be salaries expense. Okay, so that's it. So that's it for today. Hope you learned. So don't forget. Okay, good night and have a good day.